Okay, hey, yo, what's popping? You're welcome again to my YouTube channel. So I missed you a lot, you guys. Yeah, I've been busy doing some kind of teachings or something. So this time I've decided to come to you with a new thing. Remember, sometimes I can say like I'm your mentor, so I will teach you almost what I understand, I provided to you, and then you yourself are you gonna create your own trading plan that suits you. That's how it is. So the last playlist that we had, it was all about Malaysian SNR. So these things right now, it's completely different from Malaysian SNR. This thing right here is good than Malaysian SNR, right? It's perfectly fine, it's good, and also it's completely different, right? So put that into your mind. Okay. So it is what it is. So for this time, this session yeah, okay. I won't be diving that much into technical analysis because you have to understand what terminologies and things that we will be using, right? So things that we'll be using this time, we have almost, let me try to find the text tool. I like the text. Yes. Okay, that's the text. What's wrong with this? Mm, that's gotta show up with some kind of light. That's more than enough. So, okay. This time, what we're gonna use, there is something we call it constant time frame. Constant time frame. We have liquidity area. We have liquidity consumption. Also, we have something we call how do we call ranges? Or okay, I've talked about ranges, so this time I will teach again about SMC and ranges because SMC and ranges will be much more important. SMC and ranges. And another thing that we may combine with this, we may combine within this playlist, we can call it risk management and day trading, or I can call it intraday, right? Intraday. So we have these things. So this playlist, I will call it liquidity consumption theorem. The liquidity consumption theory, liquidity theory. And also what you really need to understand, there is no name for this thing. So this will be, okay, we can call it the GSM strategy, like ICT call it ICT strategy. Okay, someone who invited SMC, I don't know what's name, I don't remember well, but I know him. But for me, myself, because this thing is brand new thing, we can call it the GSM strategy. Okay, simply can call that. Okay, just was kidding. But you can call whatever you want to, but if it's you call it DSM strategy, that's fine. Okay, so then now let's dive into now today I will teach about constant time frame and liquidity area. We won't dive into liquidity consumption, SMC and SMC ranges and other stuff because why? The video will be too long. Okay, the video will be too long. So let's dive into the constant time frames and liquidity areas. And also we have something remain right there. We have something remain right here. We call it validation and invalidation. Entry types. Oh, uh, liquidity area, liquidity. I can call it liquidity area validation. We have constant time frame, liquidity area, validation invalidation, liquidity consumption, liquidity area validation, entry types, SMC and ranges, risk management, and intradays. So the whole playlist should contain these all stuffs. Should contain this all stuff. So yeah, you can mark it because I will teach one by one, and each one will have its own video, right? Will have its own video, and we dive into the live trades. We dive into the live trades, and we dive into okay, I can call it how can I call it? During testing, we can call it back testings. Okay, we can do back testing, live trades, back testings, and also we have demo trade or paper money trading. So you have to prove if this stuff work. Okay, you have to prove if this stuff work because you can learn shit things. You have to learn something that you can even apply it on the market. That's how it is. So now let's dive into the constant time frame. What's the meaning of constant time frame? Okay, first of all, I really want to tell you something like this. Always market goes by following flow orders, right? By following flow orders. So if the market follows the flow orders, the orders that remain without consumed, remember the market will go into that area and then consume that liquidity. And what you have to put into your mind or write it down because it's very essential. And without that, you won't understand this. Believe me, you won't understand. What you really need to understand is the higher time frame liquidity is not the same as lower time frame liquidity. The more you go into the higher time frames, is the more you will find a lot of liquidities. The more you go into the lower time frames, is the more you will find there's low liquidities. So most of the time, you have to really stick to the higher time frame liquidities. All right, stick to the higher time frame liquidity. So higher time frame liquidity is much more important. It's much more important. This time, then I can even suggest to other people just have few pairs to trade with. Okay, you don't need to have 4, 5, or 6, 9 pairs. No, you don't need to do that because you will lose focus. You will lose focus. Believe me, you're gonna lose the focus. Someone says that if you have only one goal to achieve, then the percentage you have for you to achieve that goal is 90%. But if you have two goals, you want to achieve two goals instantly, then believe me, the expectations or I can call what word what's the best way I can use to explain this? Okay, if you want to accomplish two goals, okay, at the same time means the ability for you to achieve those goals, it's 50%. If you have three goals or four goals and you have to achieve all of them instantly, means the ability for you, okay, to achieve those goals, now it's less than 20%. Then now you can see the more you have pairs, it's the more you're gonna have losses. It's the more you're gonna have losses. It's the more you're gonna lose focus. Okay, you're gonna lose focus. And the word focus most of the time means that fight for one cause that until success. That's the meaning of word focus. So always focus with few pairs. Have three pairs, have two pairs more than enough. Because by using this method, believe me, by using this method, you're gonna have trades almost every single day. If the day is not clear, simple. If you see nothing, you take nothing. It is what it is, okay? You don't need to trade every single day, okay? Because now you're learning about financial freedom. So if you have to pay attention to nine pairs and you have to stay all the time on the time in front of your chart or in front of your PC, then what is that freedom? So you have to trade, okay? You have to trade few things, then you have to generate a lot of money. So have few pairs, two pairs, three pairs. Like me, I have three pairs only, right? I have three pairs only. So have three pairs, our two pairs, pay attention to them. That's more than enough. Okay, those were sponsored ads. So here we go. So in here, in here, now, now we have three time frames that we use for the direction. We have three time frames that we use for direction. The first time frame is daily. Okay, the first time frame is daily that we use for direction. Another time frame is weekly, we use for direction, and another time frame is monthly, we use for direction. in monthly time frame. Okay, so you have daily, you have weekly, and then you have monthly. So then if you have these three time frames, okay, then now how can you use all time frames? In this case, now you have to really understand most of the time I pay attention to daily and weekly because monthly does not change that much. Okay. Monthly does not change that much. So monthly you can remove it. Okay. You can remove it because monthly is not that important compared to daily and weekly time frame, right? Compared to daily and weekly time frame. Okay, because why? Monthly, we have only one candlestick within a month. Okay, that's the problem. But at least on the weekly, we have at least four candles within a month. Daily, you have many candles. So the daily time frame for having the direction, of course, it's better. And you have to really understand. For me, myself, I'm teaching you. I'm not the of course, the swing trader, right? I'm not the swing trader. I cannot hold position for the whole month or for the whole week. No, 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 no. I won't do that. So that's why I will teach you about these things. So then the constant time frame are the time frames that we use for directions. So daily, weekly, monthly, those will be the time frames that we'll be using for directions. So for this case, I will talk about daily, but the same thing applied to the weekly, to the monthly, okay? It's the same laws, okay? The same laws because price is factor. What you can see on the daily can be seen on the weekly, can be seen on the monthly too. So in this case here, I will talk about bullish example, and then I will talk about bearish example. Then I will show you on the rate charts how those things work, how those stuff work, right? Okay, so for example, in here, let's say if you have let's say you have this bullish break, right? You have this bullish break. Now I'm talking about the bullish market, okay? Because the bullish market is the market that creates something like this. This is the bullish market. And the bearish market is something that creates something like this. This is the bearish market because the bearish market is, we have the bearish breaks like this. It creates lower lows and lower highs, okay? Lower lows and lower highs. This creates high and higher lows. It is what it is. So for this time, let's talk about bullish example, and then we talk about the bearish example. So in this case of bullish example, let's say you have this bullish break like this. You have this bullish break like this. Now you have to really understand, we expect the market to retrace into this bullish, okay? We expect the market to retrace into these areas first before going to the upside like this. We expect the market to do this, okay? Because not all the time the market is going to retrace within that, but we can have this kind of expectations. We can have this kind of expectations, and maybe the coming videos I will teach you what to do in this area when the market does not reach into these areas. But for this time, understand this. So let's say you have this area right here. Okay, the market goes up, it goes up, made a pullback, and then retraces to the upside. So we expect the market to come into these areas and then go to the upside. So what's the relevance behind that? Okay, why do we wait for the market to get into these areas and then go to the upside? Now you have to really understand. Before the market goes up, this was the area that a lot of people a lot of people, the majority, engage the move to go to the upside. Okay, engage the move to go to the upside. So these areas is the area where there was a lot of liquidity activities done into these areas for the sake of market to go to the upside. So if this area is the area that the market accumulates the money to go to the upside, so in this case, we call it, this will be the liquidity area, okay? This will be the liquidity area because in this case, okay, because in this case, so yes, so then if you have this area right here, this is what we call liquidity area, right? The area where we expect the market to retrace into for the sake of buying to go to the upside. Okay, so now you can ask yourself, what's the reason for the market to return into these areas? What's the reason behind why the market wants to get into this? Okay, now it's like this. For example, if you have this liquidity area, the market want to retrace in these areas for the sake of looking at the liquidity areas that remained into this bigger liquidity area that were not that the liquidity areas that were not unconsumed or something. Okay, the liquidity area that was not consumed. That's the reason why the market retrace into these areas and then it go to the upside, because in these areas we have two types of orders this time. We have limits and then we have limits, and then we have buy or sell orders, okay, that are running within these areas. Remember, when the market was going to the upside, in these areas is the moment like people, they get into this market for the sake of going to the upside. Okay, so then the market, so then what the market will, so then the market will want to return into these areas for the sake of finding the liquidity area that was not unconsumed, or in other words, the liquidity area that was not mitigated within this zone right here. Okay, not the outside from the liquidity area. No, we're not gonna look for anything above this. No, we don't want to. We are not going to do that. What we want to look is something right in these areas that was created in order for us to do what? To engage into the move. So the area that was not liquidated into this zone will be much more important, or the area that was not the area that was not mitigated. I can say that the area that was not mitigated. So we have two types of mitigation this time. First type of mitigation maybe let's say, let me put this clear. Maybe you had this liquidity area right here, the market goes up, then return by a week, then go up. Maybe you had another liquidity area in here, the market tap by the week, and then it go up. So then maybe this area is something which is clean. Okay, it's something which is clean. So these liquidity areas from right here is okay, they are no longer needed. They are no longer needed. The one that is needed is here because the orders now are resting into this area. So the market wants to take these orders and then it continue with the move. That's how it is. Because the market, if it's bullish, will tap into these areas and then do what? Go to the upside. That's how it is. So if someone says the market is run by the flow of orders, these are orders that we mean, right? This is the order that I'm trying to show you right here. So if there's nothing unconsumed into this liquidity area formed right there, it's something that we want to use. It's something that we want to use, something that we have to pay attention into, because the market is gonna react then it goes to the upside. So then I'm gonna give you types of scenarios that we may face during find the liquidity area that was not consumed or mitigated. Then I will dive into the actual examples. For example, in this case right here, maybe you use daily as constant time frame. When I say use daily as constant time frame, sorry, I mean that you use the daily liquidity area formed right there. And how do we mark out these liquidity areas? First of all, how do we mark out these liquidity areas? How the way we mark out these liquidity areas is the upper point you have to mark out on the body, and the lower point you have to mark out on the wick, right? Because why? Now we have two types. We have two things right here. First of all, you have this, what we call validation point. Why do we call it validation point? Because it validates the bullishness. And we have this point below right here. It's invalidation point. Why? Because if the market will retrace back down and then close below this wick, now we understand the market shift. The market did a shift, okay? The market has shifted. So the market is no longer bullish. That's why we say it invalidates the bullishness. So now we are bearish, right? So during marking the point, the validation point, you're going to mark it on the body. The invalidation point, you're going to mark it on the wick. I hope it's clear, right? I hope it's clear. So this time you have validation, you have invalidation. So you will go into the 4-hour and then find something that was not consumed within these areas. So you may go into the 4-hour and then you may have one area right there, another area in here, and then goes to the upside. So the first scenario is this. Maybe this one was consumed by the wick, this one remained unconsumed, and this one also was consumed by the wick before going to the upside. So this area will be the area that you have to focus, because this is the POI that you have, okay? Because the order that we have orders now resting into these areas, so the market will retrace into this zone right there, and then you buy. Okay, and then you buy. That's the first scenario. That's the first scenario. And another scenario, it's like this. Okay, another scenario, it's like this. Maybe you have this liquidity area from right here, and then you go into the 4-hour and then check for the liquidation process. Remember, after having the liquidity area, you have to go into the lower time frames to check the liquidation process. Liquidation process, which means that you have to check the liquidity area that was not consumed. The liquidity area that was consumed means it is already liquidated. You have to find something that was not liquidated, because now the price is going to use that as the POI. So if you're going to check here, maybe you're going to see, maybe on the 4-hour, you're going to have this point right here. another point right here, another point right there, and then goes to the upside. Maybe this point was mitigated by a wick, but this one was not liquidated, and this one was not liquidated. So which one are you gonna use? Which one are you gonna use if you have 2 points then? If you have 2 points, always the liquidity area has to be formed into two areas. Okay. For example, this will be the next session. I teach you about how you validate the liquidity areas. For example, in this case, now, if you have two liquidity areas on the 4 hour, now go into the one time frame higher. Let's say in this case, you have to go into the daily. So if you go into the daily, maybe this liquidity area was formed on the body of the candle. And this liquidity area was formed on the kissing candles, or on the opening close of the candles, or on the overlapping wicks on the candles, right? Where the another candle closes and another candle open within that. So the one that has been formed within the open close level is the actual liquidity area, and the one to the upside is not the liquidity area that you have. So the market will tend to do what? The market will tend to tap here and then it go. So this one is no longer the liquidity area. So that's the best way you can use to filter out those liquidity areas. Okay, you can use to filter out those liquidity areas. And another case is like this. Case number 3. Let's say you have these liquidity areas, but the price was going by consuming itself. Okay, price was liquidating itself while going to the upside. So there's nothing in here which is maybe the something that was not liquidated. So what you gonna do? What are you gonna do? What are you gonna do this time? Okay, it's like this. If you see nothing, you take nothing, because why? If there is nothing unconsumed into these areas, then you have to agree with me, the market will break these areas and then find something unconsumed below and then go to the upside. That's how it is. If there is no orders, what's the reason for the market to return into these areas? There's no reason for the market to do this. That's why you see some people, they get induced by this move. They say this is the breakup structure, but they didn't even realize that the market was seeking the liquidity. So if there is nothing to take, the market is going to break these areas now. The market is going to break these areas and go to the upside. So it is why it is. So we have those 3 cases in bullish example. So let's dive into the bearish example and go into the charts. So for example, in the bearish example, let's say you have this bearish liquidity area created into these areas. Validation point, we mark out on the body. Invalidation point, we mark out on the wick. And then maybe this picture, maybe you use daily as constant, means daily time frame is the time frame that has this picture. Then you try to go into the 4 hour and then look for the liquidity area that was not consumed. If you see nothing on the 4 hour, go into the 1 hour. If there is something unconsumed into the 1 hour, it could be better, because the market will go up, take that area, and then it goes down. Okay, it goes down. So it is what it is. So the same, okay, you're gonna use the same rules used into the bullish example. It will be the same rules that will be used in the bearish example. So now let's dive into the charts, right? Let's dive into the charts. Okay, in this case right here, for example, now I'm gonna use like daily as constant time frame, like the way I was teaching you. Daily as constant time frame. So in this case right here, I'm gonna give you the example in here, example in here, example in here. Yeah, I'm gonna give you even the example in here, even though this was the weekly liquidity area, I'm gonna give you the example where this market reacted from. Case number 1. Okay, now let me put a replay to in these areas now. Okay, now we have this case. Oh, let's start from here. I'm gonna show you a lot of examples now, because they are everywhere. So in the setting. Okay, this time you had the bullish liquidity area from the day. Which one? This one. Look how I mark them, right? Validation, because it validates remember, this was the bearish liquidity area, but now the market did what? The market break the bullish liquidity area. So now you mark out on the validation point and invalidation point. And then you're gonna check the liquidation process within this liquidity area, not outside. Okay, bro. Just don't try to make an idea. It's not outside. Not outside. So you go into the 4 hour and then check the liquidity that was not consumed. So if you check on the 4 hour, now you can see you had one liquidity area. The market was going like this, one liquidity area in here. The market came down and then it consumed it. You had another liquidity area, this bigger one. The market came down and then it consumed it. But you have something in here that was not consumed. If you look clearly, in these areas right here, you have one liquidity area that was not consumed in these areas, like this. Okay, so today I'm gonna teach you how you're gonna choose these liquidity areas, and next session I will teach you about how do we refine those entries, how do we refine your other stuff. So you had this liquidity area that was not consumed. So if you have only one liquidity area that was not consumed, then what we're gonna do? You have to wait for the market to just see and then you buy. So someone can say, oh, someone can say, let's say after looking on the 4 hour and then he goes into the 1 hour and then finds something right here. Yes, if you have something right here, believe me, if there is liquidity area that was not consumed into the 1 hour in these areas, believe me, it never not work. Okay, let me go into here, because some people, they want to mess up their minds. That's how they are, because on the 1 hour within this liquidity area, you have the liquidity area in here that was not consumed. Remember, if I do something like this is the bullish liquidity area in here. It's the bullish liquidity area in here, because why? The market was going like this, okay? Because why? The market was going like this, goes like this, and then it goes to the upside. This is the liquidity area created in this 1 hour time frame. So someone can say, oh, I have two liquidity areas, one from the 4 hour, one from the 1 hour. Which one I will use? I told you, the more you go into the higher time frame, it's the more you're gonna see, maybe you're gonna get a lot of liquidity. So between the 4 hour and the 1 hour, which one is stronger? Of course, the 4 hour. So the 4 hour liquidity is stronger than the 1 hour liquidity. So if it's stronger, means that you're gonna use the 4 hour liquidity to maybe to buy from that. Okay, so always escape this one. Okay, escape this one, because the 4 hour is stronger than the 1 hour. That's why I maybe like the way when I teach my students, I told them you have always to check the all time frames. If the higher time frame has the liquidity which was not consumed, even though you're going to the right time frame and they see other liquidities, it's not those liquidities do not matter anyway, because the higher the time frame, the more the liquidity. That is the principle. Okay, who created that principle is me myself. The higher the time frame, the higher the liquidity. The more you go lower, the more you find less liquidity. It is what it is, right? I hope it's clear. So you had one liquidity area that was formed right there. Okay, that was formed into the 4 hour. So I say we're gonna put into these areas. And then now the same applied the way we mark out the validation point in the validation point, and it's the same way we used to mark out the liquidity area. So in this case, you have this liquidity area in these areas that was delivered from the 4 hour, not from the 1 hour. From the 1 hour, you had this one too. But you know why we escaped this one, and then we remained with the 4 hour, because 4 hour is stronger than the 1 hour. So let's go into the 4 hour. Let's see where the market reacted from. So then the market was messing around. So someone can say, oh, will I wait for the whole days for the market to get here? No, because I've never taught all stuffs. Remember, now I'm teaching you to see how liquidity area work. I will teach you intradays and other stuff. But this time, I'm teaching you about liquidity areas and understand why the market reacted. So the market goes down, messing around, messing around, messing around, messing around, messing around, messing around, messing around. And then what happened? Tap right there. Yes. That's the moment to get the actual move to go to the upside. To get the actual move to go to the upside. So someone can say, oh, see the market now. Okay, see the market is pushing to the upside. This liquidity area will never be used. No, 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 no. The market will follow that order. Believe me, you have to learn to trust this. I will give you a lot of examples, so don't worry about it. I will give you a lot of examples. So let's go into the daily and then look another liquidity area that was formed. And there. Now, these days, we have another liquidity area which was formed around these areas. From here, validation point. In this case, invalidation would be right here on the swing low, not here, on the swing low right there. Validation point, because it validates the bullishness, and invalidation point. So we use daily as constant. Let's try to go into the time frame and then see which liquidity area that was not consumed. So in this case, let's try to go into the 4 hour. If you try to go into the 4 hour, now you can see the market was consuming itself. Remember, the market create the liquidity area right here, and then it come down, and then it consume it. Create another liquidity area, come down, consume it. Goes up, okay? The market was consuming itself, but this time you remain with the one liquidity area in that area. Remember, I don't find something outside from the liquidity area. I don't find out something outside. So in this case, you have what? You have one here. That's what remained. Okay, you mark out on the body, like the way you mark validation, any validation on the wick. Then yeah, let's see where the market reacted from. In this case, goes down, top right there, goes up. Okay, goes up. Now, let's try to find another example, right? Let's try to find another example. This day, okay, this day I do remember this day, even though I was not good at this. This day I had this bullish liquidity area formed into these areas now from validation and invalidation here. Validation, now I will show you something that did not play, but I will show you how I managed this thing. I just come into the forward time frame, and then I quickly realized I had this liquidity area where this one was consumed. Do you see? If this liquidity area that was here, remember the market created this liquidity area, goes up, come into it, consume it, goes up, come into it, and then consume it by a week. Now on the 4 hour, we don't have liquidity area, seems to be unconsumed. Let's go into the 1 hour. If you don't see something on the 4 hour, now go into the 1 hour. Okay, so into the 1 hour, we had this liquidity area in here that was not consumed. Everything below consumed. This one consumed by this week. Everything below, I think you can see the market was consuming itself. This area is cleanest area where we can pay attention. So for this case, I could define it into the left shoulder right there. Okay, so if you don't understand, do this. Okay, do this. Okay, no problem with that. But it was unfortunate because the market did not come into the liquidity area. So what the market did came all the way down and then start going up. So do I get bothered now? No, I don't get bothered because I didn't understand the structure. So if I understand the structure, if the price failed to get into this and then create another liquidity area from the 4 hour time frame, because 4 hour now is acting like a constant time frame now. Okay, why 4 hour is acting like a constant? Remember, answer we dive into the ranges. Now you understand why I choose this liquidity area for me to use to buy from. Okay, I'll use it to buy from. Yes, and then the market goes to the upside. It is what it is. So let's find another example from the daily. Now I showed you why the market did not get into this liquidity area. That's the problem. Okay, that's the problem. Now you had another liquidity area created into where? On the daily time frame. Which one? You had another bullish liquidity area in where? In these areas. Validation point and invalidation point. So what you're gonna do? Let's dive into the lower time frames. Let's check on the 4 hour, something that was not consumed. Into the 4 hour. Now if you check properly, into the 4 hour, we have this one. We have this one unconsumed. We have this one unconsumed. So let's see if the market get there. Remember this one. So now I'm teaching you about liquidity areas. Remember, I'm teaching about liquidity areas that was not consumed. I'm not teaching you about let's say I'm not teaching you about something, let's say about refining or something. No, now I'm really focusing on teaching you how to mark out the liquidity area that was not consumed. I think you see there's not even a wick came into this liquidity area because the liquidity area has to be something like this. Remember, the market goes up like this, create this liquidity area in here, and then it creates another one. The above liquidity area was consumed by this week. The market goes up, consume it, and then go up to the upside. This one was not consumed. This one was not consumed. So let's pay attention to this. I don't know if the market reacted there. I think this could be the brokerage or something. I think on FTMO, because these days I'm using FTMO. On FTMO, I think this area there was some kind of something which was here or something. There's something that was remaining to these areas. I do remember this trade. I took this trade from here. Yes, but no problem with that. Here we go. No problem with that. Let's go into the daily. Oh, let's check on the weekly first. What we have on the weekly before. Okay, UK news. Okay, on the weekly now. See this. Now the market was going to the upside, and the weekly was having the liquidity area that was not consumed. If I use this now, you can see you have another liquidity area from this week here to the week above. So you have to find these zones to see the liquidity areas that remained unconsumed. So here we go into the daily time frame and then check. Into the daily time frame, if you see clearly, you can see this liquidity area was consumed by this week. The week came into this liquidity area, this week came into this liquidity area and then sell. So then this is not good. Okay, this is not good to use. Let's go into the 4 hour within the same area and then see what we can pay attention into. So within this area on the 4 hour, you can see we have one liquidity area in here that remained unconsumed from here to here. So this time it's like I'm looking on the real chart. I have no idea because I didn't backtest this thing. It's like I'm looking on the real chart. So let's see what the market reacted from the upside. Yes. Can you see that? Can you see? Reacted there, goes down, and then it goes up. Do you see? Can anyone tell you where the market is reacted from? It's nothing but it's coming from the father. Now, someone who knows Malaysian, because okay, I'm not trying to show like Malaysian SNI is no longer work, no, because something that works into the market differs from person to person, right? Malaysian SNI, someone from Malaysian would use this resistance maybe, but in this case, we use the liquidity area because it makes more sense rather than having what? Rather than having what? Rather than having the what we can say, rather than having the Malaysian SNR thing. So then, why? Because this area was only to give us the pullback towards the daily liquidity area that was formed around that area. From here to here. So which zone are we going to use now for buying? Which zone are we going to use? Let's try to go into the 4 and then see something in there. On the 4, I think you see on the 4 you have nothing. On the 1 hour, you see, on the 1 hour, you had nothing, nothing, nothing. You have only one thing remained in these areas that was not consumed. The liquidity area that was not consumed is right here. Okay, because why? If you can see properly, this liquidity area gets consumed by this week. This liquidity area gets consumed by this week. This liquidity area gets consumed by this week right here. But this one created in here, if I try to do this one created in here, this liquidity area in here, there's nothing that came in consume this thing right there. So you have that liquidity area marked out. So if you have that, what you're gonna do, you have to wait. When the market retraced back the downside, yeah, this will be the area that you have to pay attention into. So where the market reacted, see, the market calmed down in these areas, top right, I think, top right there. Then yeah, goes to the upside. Can anyone tell you what is this? No one. But if you know the liquidity consumption, it's the moment you're gonna realize where to enter and where to exit. Where to enter and where to exit. You're gonna realize that. Believe me, you're gonna realize that. So this time, so someone can say, oh, now how can I take the intradays? Wait, the intraday session is coming. The intraday session is coming. So then you had this liquidity area in here, then it goes to the upside. So in this case right there, I use the weekly liquidity area. I think you understand the weekly and the daily, which there's something stronger is the weekly. So these days I had from the weekly, you can see clearly from the weekly, let me play this kind right here. Okay, from the weekly, I had the liquidity area formed into the weekly one. From this validation in there, broken, and invalidation point. So where can I enter from? Where can I enter? Let's go into the daily now. If you try to go into the daily, now you can see on the daily you have remained the one liquidity area in here that was not consumed. From here to here, this is the liquidity area within the weekly liquidity area. This one was not consumed because there is no wick, nothing that came into these zones. That's fine. So can you use this area and then can you put stop loss below now? No, I just go into the 4 now. I just go into the 4. And then into the 4 if you check clearly, you had the one liquidity area in here that was not consumed though. This from here to here. So if you try to check where the market reacted from, then you will quickly realize the market reacted from where? From this zone. And then yeah, go to the upside. Go to the upside. Okay, go to the upside. So now someone can say, does it work in gold? Absolutely, yes. It worked clearly on gold. Let me try to find 2 examples on gold, and then let's finish this video. And then the next video, I'm gonna put, it's gonna be much more clear because I want to combine everything into the one video. It won't be like that. So on gold, how it work? Someone can ask, how it work in gold? Yeah, one example from here. These days, I can say it was the very cleanest day because I had this liquidity area formed into the daily time frame. From this was the validation, invalidation. Let's go into the 4 hour. If you try to go into the 4 and then check liquidity area remained within this liquidity area that was not consumed, you can see you have nothing. Everything this consumed, the market was going by consuming itself, right? The market was consuming itself, means the all orders were filled. Okay, on the 4 hour now. This is the picture we see on the 4 hour. Let's go into the 1 hour. Maybe you can have something into the 1 hour if you don't see anything on the 4 hour. On the 1 hour, this get used by this week. In here, nothing remained. So if nothing remained, what are you gonna do? Let's go. Okay, let's go into 30 minutes. Maybe you can have something. You can have something. Into 30 minutes, you can see this area gets consumed by this week. This area gets consumed by this week. This liquidity area formed right there gets consumed by this week. So we have nothing. Okay, in this liquidity area, we have nothing to take. So if you have nothing, what are you gonna do? If you have nothing, you have to put into your mind this area would be taken out for sure, because if there's nothing to take, there's nothing, the market won't respect this anymore. So if you try to look below something that was not consumed, you can see these areas right here get consumed. Okay, this right here gets consumed there. Market consumed it. This right here gets consumed. Okay, gets consumed. So if you try to look properly, it's the moment you realize this formation here was not consumed. This formation right here was not consumed. There's nothing came into this formation. So I think below that, because as we understand there's nothing to take in here, and you know the liquidity consumption that the market will suddenly will do this because there's nothing to take. So what happened is this: the market is started going to the downside, goes down, tap right there, goes up. Simple, simple like that. It's simple like that, believe me. Simple, simple like that. Okay, simple like that. So you don't need to complicate things. You don't need to get complicated stuff. No, things are very easy. Okay. Now remember, I was trying to show you the example from the constant time frame to the lower, but we have a lot of example you can use for hours constant. You can use in terms of intraday. So now I was trying to show you the where the market reacted from other stuff. So let me find one example. Okay, one example. Okay, because I can choose anywhere. Okay, I can choose anywhere. So in this case, let me try to find the weekly example from the 1 week. I think it will be a good example to have. In this case, we had the weekly liquidity area formed where we have this validation, invalidation. So we expect if the market we want to go into the weekly liquidity area has to do this and then go to the upside. So if you try to go into the daily now, on the daily time frame, what do we see? On the daily time frame, we have many liquidity area this time. You have this one, not consumed. Right there. You have this liquidity area right here, not consumed. You have this liquidity area here, not consumed. So which one are you going to use? Which one are you going to use this time? You have many now. Which one are you going to use? I told you the liquidity area has to be formed into two areas. Liquidity area has to be formed either in weak overlap or in long wick rejection candles. So if it's not between that, yeah, why are you trying to stress your mind? Let's go into the weekly, the one time from higher, and then see into the weekly. This liquidity area here is formed from nowhere. Just remove the line. This liquidity right here formed from nowhere. Do you see? It's between the candles, but the liquidity below in here formed within the candle overlap, or can say the opening close level within that. So this is fit the criteria. So if it fit the criteria there, that's fine. You just go into the daily, and then you have this liquidity area in here. So how can you refine this zone? Okay, so now you can find the best way to refine that zone. So let's see on the file, how can we refine this zone? Remember, within this. On the 4 hour, if you try to look clearly, you can realize on the 4 hour, there's no way we can define this. Let's check something on the 1 hour. On the 1 hour, you have this from here to here, because both this one was not liquidated and this one was not liquidated. So let's see, you have two. Let's see which one fits the criteria. This one and this one. Let's see on the 4 hour which one fit the criteria, and then we're gonna use it. Okay, the one to the upside fit the criteria because why? It is formed within the open cross level. This one from nowhere. So mark it out like that. Mark out maybe from the week right here, because since the stop loss is too small. Yeah, let's go into the day and they see where the market reacted from. The market is started going up, goes up, started declining this time. Tap there, go. Tap there, go. No one will understand why you choose this. But now if you know, you know, right? If you know, you know. So for this time, this is more than enough. Next video, I'm gonna teach one step by step until we go further into other topics. So this time, have a good time. Bye bye.